Welcome back to the channel Trading Simplified. I'm a trading enthusiast and love to simplify trading. To get started, just a reminder that I'm not a financial advisor and this video is for entertainment purposes only. What's up, everybody? So today is going to be about exchange traded funds. Now, what is that? This is an ETF. Basically, it's a basket of securities that you buy through a brokerage firm such as Fidelity, which is what we're on. And basically what you're doing is you're not just buying one stock. You can buy like sectors. You could buy the financial side. You can buy banks. You could buy energy. You could buy pharmaceuticals, and you can buy customer service or like things like Coca-Cola and Pepsi, like consumers. And I just wanted to go over it and show you how I would look and what I would look for and the criteria that I want. Now, this is a long-term investment, and this is like how I find where I want to invest in and what I think could be a good investment over the long term. And I'll show you just a little bit of things that I like to do to kind of, ease it out. So here's what I do. So I go into the search bar, I type in ETF, I click enter. And this is on the Fidelity website for anybody that's wondering. I'm just starting from the beginning so everybody can see. Then I click on Find ETFs. And ETFs are good to hold. They're good long term because you're investing in a basket of companies. You're not just doing one company. You're going long term to see, that it's going to hold a bunch of companies and you're going to invest in over long term. Now I stick with the Fidelity, so I click on Fidelity here. And you can find free commission ETFs. Now, what does commission free mean? That means every time that you buy, they don't charge you. They just charge you at each year an expense ratio. So now we have all of these things, right? And this just looks like, for anybody that doesn't invest that much money or doesn't invest at all and is just getting started, this looks really confusing. But the first thing I want you to do is when you're looking at ETFs, before you even look at anything, I want you to go to net expense ratio. This is how much the ETF will charge you just for owning them. So each year they will charge you a rate. So over here, there's net expense ratio. And we're just using this one because it's the first one I see. And they charge you 0.08. So that means they charge you 8 cents per $1,000 that you have in them each year just to have their fund. And that's the one expense ratio that they'll take from you. And it just comes automatically. It'll just come like if you own $1,000 worth of this FTEC symbol, that would take out 8 cents per $1,000 every single year. And it'll keep continuing to invest your money. But ETFs offer a lot of good things. They offer dividends. They offer, a good protection against the market in case it goes south. You have the NASDAQ right here. So this is if you just want to invest in just the NASDAQ and you want to, this is a higher expense ratio at 0.21. And you can invest in them. You want to invest in healthcare. You can invest in bonds. You can invest in real estate. You can invest in the banks, Morgan Stanley, Bank of America, all them. If you want a dividend ETF that just pays you dividends, you can invest in them. And there's just so many different choices. So the first thing I like to do is I like to go to the expense ratio. And this is where it is right here. And I want a low expense ratio. So look, right here, it's already, if I click on this box and hit very low, so it means I'm paying a lower expense ratio. And I want an even better ratio. When you buy an ETF, you want it under 0.1. You don't want to pay anything more than that because it's, they're not even doing anything to manage your money, but they're charging you a fee. So we're going to put it for 0.1. And look, now I have only, instead of those 64 options before, I have 11 options to choose from, which means that my money is going to get more bang for its buck. Now, I always think everybody should have their money. In previous videos, you'll see in like the S&P 500 or the NASDAQ. But I do believe, like if you are a big believer in healthcare and you want to start allocating 5% of your portfolio, you could start, just adding money in this long term. So the expense ratios are here on the right, and this is how much they're going to charge you each year, which we just covered. And it's around 0.08 to 0.09. So now I say, okay, I like this. This is what I'm going to look into. So I'm going to look into energy. This is one that I actually own long term, and I put money in it just over long term. So now I'm on the Energy Index ETF, and it's worth $15.59. And just to kind of show you how it works, is they charge you 0.084%. And it's right now, you can see where it's been. So it used to be $7, now it's at $15. And with ETFs, you just want a dollar cost average. You want to buy them over time. Because I'm looking at the 1 year, it went up 90% in 1 year, so this might not be the best time to buy. Because you're really buying it like super high. But that's why you buy and you add every couple months. So you just add money to it every month and then you just forget about it. But let's get into more detail about this ETF. So comparing this ETF to others, you have similar ETFs, and this is Vanguard. This is all different, like, place where you can invest your money. Your expense ratio is the best, 0.08% compared to 0.1, 0.41, which is a big expense ratio, 0.12, 0.4, 0.4. That's how much they're charging you. And this energy index, we'll put it into like ExxonMobil, Chevron, Coconut Phillips, whatever. All these guys, right? And they think solar energy is going to be a big deal in the future. I mean, this could give you, instead of trying to buy one company if you like solar, you could just invest in this and then get the coverage, because your top holdings make up 64% of this company. So now, instead of just investing in just ExxonMobil, you get to invest in all of these guys. Now keep in mind, ExxonMobil is 20% of this company. ETF. But you have 99 total companies that you're investing in. So it kind of balances it out so you can get more coverage. And then it shows you, it's like all North America companies, meaning United States. And it shows you the 1, 3, and 5 year return. So it hasn't done too well over 5 years, actually. It's actually down. So these are things you want to think about when you're looking into it. They offer other ETFs, which I'm trying to see how I can get back to this. Let me just click here under ETFs and see if it shows. And okay, that's fine. So we can just go back into it real quick. And when you're looking into this, that's the energy one. But then you could go into financial. Say you think like banks are going to go up over the future. You just want to be part of the banks, but you don't know which bank to buy because, not all of us want to sit and watch stocks all day. So you just say, hey, I want to be part of the bank industry, and I want to, diversify some of my money. And I think that banks are going to go up. So I check my expense ratio. It's very nice, the 0.08. And then I'm going to say, well, what companies am I investing in? I'm JP Morgan, Berkshire Hathaway, Bank of America, Wells Fargo, Citigroup. So all the banks that everybody knows, now you own a piece of all of them. And this fund invests in 389 different banks. And they always show that the top 10 holdings, how much of the top 10 holdings makes up the entire ETF. So these 10 companies make up 41%. But it's better than just buying Goldman Sachs because you think they're great and then they go out of business. Now you lose all your money. But if Goldman Sachs goes out of business, you still have all 388 more companies that could invest in. So it's not going to kill the stock, and you're going to be able to just do it over time. And I really like Fidelity. Fidelity is my long term. I just feel like they always have good expense ratios when you compare them to everybody else. And I just feel like they give you a lot of bang for your buck. I think Fidelity is a good place to park your money long term. And then you can look at the 1 year, 3 year, 5 year. And look, it's up 15% in 5 years. And then you can go to here and look for distribution and expenses, and this is how much they're going to charge you. So look, it's charging, let's see here, they charge you 0.08 like we said, and just to bring this up so you can see it, I think if I click on this, it'll actually show us a definition, and that's what I really like about Fidelity. They'll explain things to you too, which is kind of nice. So it's showing you that the gross expense ratio is the annual percentage that is paid out to them for managing your money. For you putting in XYZ amount of money, they're getting paid to manage your money. And that's just one more. I just want to show one more that I think would be, beneficial. Say, I don't want a specific sector. I want to just own the NASDAQ or the S&P 500 ETFs. They have that as well. And I'm just clicking through fast just to show it. But they have bonds here as well. They have the NASDAQ here. I'm trying to see if they had like an S&P 500 or something. These are all different. All right, so let's go back to the thing. We're going to go back to the expense ratio. We're going to hit very low. Or you can just change the number up here. And they have all different ones that you can do. They have dividend ones. Let's click on the dividend one. It's a higher expense ratio, 0.29, but let's see what they pay for their dividend. And now I'm a big fan of the SCHD, Charles Schwab one, but let's just look into it and see. So they charge a hefty expense ratio, but let's see what their dividend is. So the dividend's 2%. Now that's not too good to me, to be honest. I'm going to invest in multiple companies, but I don't know which stock to invest in, Coca-Cola, AT&T. Instead of that, I'm going to own 129 companies, and I'm going to get a dividend, and I'm going to put my money in it and just leave it. So I have Apple, I have Microsoft, I have Johnson & Johnson. So I'm kind of repeating myself, but it's just showing you that ETFs give you broad coverage. You invest in over 100 companies in one ETF, and it makes it simpler for you. And you just invest in it long term and let it just do what it's got to do. And that's all you do. Now I'm going to show you SCHD because I invest in them. I have money in them, and I'm holding them for the next 30 years, and I just always add to them. And look at that expense ratio, 0.06 compared to the other one that was 0.29. So that's better right there. Look at my dividend that they're going to pay me every single year, 3%. That's even better. So look at that. I'm getting more bang for my buck right there. Less money out of my account, and they're going to pay me just for owning this. And look at this thing. It's grown from $55 to $76. So making good money on HCHD, but SCHD. And to show you their top 10 holding, they have 104 companies, and 40% make up this. So out of the 104 companies, the 10 of these guys make it up. The Coca-Cola, the Pepsi. And I used to, a couple of years ago, I used to be like, let me buy like Coca-Cola, which I do own Coca-Cola. I own only like $800 worth. But I'd rather, and I hold them for the long term because maybe they'll be worth something in the future, like just giving me dividends throughout the years. But I'd rather have the protection and own 104 companies and know that it's not going to go out of business. Know that I'm not going to wake up one day and Coca-Cola goes out of business and I lose my entire investment and I kept putting money in them over all these years and then they go out of business. I'd rather have peace of mind, sleep at night, put my money in this account and know that it's going to go up over time, I'm going to get dividends, and I don't have to worry about it. So I just wanted to expose you just to another way of investing that you can just do dividends. You can buy ETFs and get that coverage. And I think that's another way to invest long term. Now, you always want to make sure you're not doing like 100% of your portfolio into something. You want to spread it out. You buy some of the Dividend ETF. You buy like the bank, the banking industry. You can buy energy, and you just spread it out. And you just put the money in over long term, and you'll be okay. But I mean, the number one that I always say, I'm just going to bring it up because it's in my other videos, but I don't want to mislead anybody. This is the one fund that I do basically the majority, 80% of my money goes into this. Besides my day trading, which is a separate fund, but I put it in the 500 S&P fund because the expense ratio is 0.015, and it's just track record. Everybody compares how they're doing to the S&P over time. So it's just something that I like to show that I invest in, low expense ratio, and when you go under fees and distributions, how much they charge you, right, each year, it's only 15 cents per $1,000. So for me, that's a great deal, and that's what I do. I look at ETFs, I buy S&P 500, and I invest those long-term in the retirement account. And I buy a few things like Coca-Cola and stuff, but I don't put too much money in them because I don't know how they're going to do 30 years from now. I'm not directly working with the CEO of Coca-Cola. I really don't know, but I can put my money in these kind of things and not really worry about it. So that's just long-term perspective. I just wanted to bring an idea so people understand when you're looking at ETFs how to do it. If you have any comments, you want me to elaborate on anything, definitely just bring them up and I will definitely break it down even further. But I just wanted to give a quick video just to show how I use ETFs and like looking at that expense ratio and how to make sure that I'm getting a good diversification of my portfolio and just I can sleep at night putting my money in these things and I don't have to worry about it.